Good morning everybody. Today we're going to be discussing the average true range indicator, or ATR as some people know it, and we're going to be utilising the software on TradingView.com's charts to do so. So let's head over to GMGI, and we're going to try to use an example on a release of an earnings report from GMGI. So what is the average true range indicator? Okay, it's a measure of the market volatility, calculating the average between the high and the low prices over a set period of time. A higher ATR means more volatility, while a lower ATR indicates a stable market. Stable markets are a lot easier to trade in. Volatility can be very risky and very dangerous. It does not predict price direction. Okay. Right, so let's utilise ATR to trade a stock. So yesterday it released an earnings report which seemed to be quite positive. Nothing really changed, to be quite honest with you, but there's a further video on this. These black lines are key areas of interest where the stock has shown some support or resistance and rebounded in previous weeks, months, or maybe years gone by. There's a hell of a lot of volume in and around this price area, but we're going to utilise ATR to trade this stock. Okay, so let's look at ATR. So at the moment we're going to change this over to a weekly time frame, and we're going to use the last 13 weeks, which is roughly a financial quarter of a company's report. So 13 weeks, roughly 3 months, there or thereabouts. And how has this stock been performing over the last 13 weeks? 31 cents. Okay, so on average this stock moves 31 cents up or down within a week, and that doesn't mean to say that if it opens at $2 it's going to move down to $1.70 or 67 cents. What it actually means is the stock will move there or thereabouts. It could go higher, it could go lower, but the average is 31 cents. So we're going to utilize that, okay, to put a long position in on this stock for next week. Okay, so let's get the long position and let's put it at where we potentially might see this stock opening. So we're going to put it bang on $2, and we're going to set our stop loss at just below the ATR. So at the moment ATR is 31 cents. Okay, I mean, realistically what you could say is, let's look at this stock at the moment. Okay, previously in February it was in at around the $1.80. okay, and on Friday it actually reached $1.87, opening at $2.05. okay, so what is that as a move? Right, so if $2.05 it opened and it went down to $1.87, that made a move of 18 cents lower. Okay, but its average is around 31 cents per week. Okay, and now we're looking at a daily time frame. Okay, let's just look at a weekly time frame for a minute, and let's look at a last week. So it's open £2.10 or $2.10, and its low was where's its low? $1.86. okay, a 24 cents move, on its average is 31 cents. So potentially if you entered into this stock at its lowest point, then you could set your stop loss down here. Okay, but if you entered it around here, then you're still in the stock for next week. You've not been stopped out, you've not been taken out by any algorithms or trading bots. You're still in the stock. Okay, so that's how you can utilize ATR to enter into a stock. So what you could say is, okay, it opened, let's have a look at what happened in the week. Okay, so Monday, where is it? Friday, Monday. So 17th of March the stock opened at $2.10, and you were monitoring this stock to the point where you wanted to get in around this line, which we've done so. And as soon as you get in, you've entered your stop loss in and around the ATR 31 cents, which means you're risking 15% of your balance to make where would we move this to? 31 cents. Okay, So you're breaking even, aren't you, really? You're risking 15% to make 15%. What I would say is I want to stay in this stock for as long as I possibly can. Now, I know there's heavy traffic in this area, buyers and sellers, but what I do know is, if you've done your research, your 50-day moving average has started to straighten out and potentially now is on a uptrend, curving upwards, with the closing of prices being higher over the past couple of weeks. The anchored volume weighted average price we've listed here onto the chart, dated back to July, is also leveling out, and the price is magnetised towards that several times, so there's a squeeze. The financial year's anchored volume weighted average price, which is dated all the way back to January 2024, has also started to level out and started to magnetise towards price. And what we would expect is this stock now, with accumulation of buying and selling, but a squeeze, okay? And what I mean by that is on Friday, with these short sellers, let's just look at what happened on Friday. So when these released their earnings report on Friday, short sellers stepped in and tried to push this stock lower, but instantly, the minute it dropped below the anchored volume weighted average price, savvy, clever investors who've done their research and know that this stock, right, at this moment in time is priced cheaply in relation to the industry that it's in, stepped in and started to buy more stock, in turn lowering their average price for that stock, whilst also building up the quantity of stock that they hold, which is bigger gains for when the stock does eventually move. And what we're expecting as savvy investors is the stock next week to go back up towards the $2 mark, and it will potentially then magnetise towards the average volume weighted average price, and once it breaks through here and hits sort of the $2.50 mark, potentially take off a bit of profit off the table, because we know there's heavy traffic, we know there's potentially going to be a rebound, right? But what we suspect, okay, is the rebound will come up to here, rebound around the average volume weighted average price, and then break through all the way up to the financial year's anchored volume weighted average price, which is a nice earner. It's a roughly 80 cents earner for potentially holding it for a week or two. That's not a bad return. Let's be honest, if you were to set this properly, that is a 40% return over 2 weeks on a 15% risk on your investment. Okay, we trade daily, entering into the market, and then we enter on a weekly market. And what I mean by that is we look at the bigger picture. Okay, so the bigger picture at the moment for us would be accumulate our shares over this period of time. When it goes into this price area zone, we're going to buy more because we see the stock as being cheap, and then we're looking to exit as it moves up towards the anchored volume weighted average price for the financial year, which is clearly being a magnet in past months and weeks. Sort of hitting, it broke through the price in this April 2024, but we do suspect that once this stock breaks above this area, it is going to carry on up to this level of interest, which is around a $3.70, where it again potentially may meet more short sellers pressure, and it'll push the stock price back down again. But we're going to heavily monitor this stock and see how it performs in relation to its current industry at the moment. The earnings per share is roughly 40 cents per share, and if we look at the stock's overview, its price per earnings ratio is 4 times, so you're paying 4 times more for the stock in relation to its earnings and the industry that it's in. The average PE is roughly around 392. So you know, when you think about it that way, you're paying 388 times less compared to its average PE in the industry that it's working in, which is electronic gaming and multimedia. So as I say, we're going to cut that video short now and finish off here. But if it's been of interest, by all means, let us know. Any questions, leave them in the comments.